In this video, I am showing how my daughter's retirement portfolio is set up and how it's changed over the years. About 10 years ago, my daughter inherited $14,000, and thankfully I convinced her to use it to start her retirement account, and she was just a teenager at the time. So I decided to invest it in to create a fairly risky portfolio for her. Some of you might not think this is particularly risky, but I do. And I chose four different mutual funds. The top two are invested only in U.S. stocks. This one's a broad U.S. stock market fund, but it mostly contains just larger companies, mid to large to giant cap companies. I also wanted her to have some exposure to small cap companies in the U.S., so I put some of it in the Vanguard Small Cap Index Investor Fund. And then the bottom two funds are funds that invest in equities outside of the United States. This one invests in mostly small cap companies outside of the U.S., and this one is a broader, larger company, non-U.S. fund. Vanguard has a rule or a requirement that you have to put at least $3,000 into a fund when you first open it. And I wanted these three funds to be approximately equal in terms of how much money was in each of them. And then I wanted the U.S. larger equity market to have the highest portion of the four funds in it. So this is how I decided to break down the $14,000. This is a decision I made based on what I thought would be a good risk level for my 13-year-old daughter at the time. And I want to calculate the weight. I can look at the dollar amounts, but it's easier when I'm just discussing what amount is in, let's say, U.S. versus non-U.S. companies or funds. It's easier to discuss it using a weight. So the total amount invested is $14,000, but the VTSMX fund, larger U.S. equities, is $4,760 of that. So I'm going to take this $4,760 and I'm going to divide it by the total $14,000. And then I'm going to make the $14,000 what they call an absolute reference. So when I copy this formula down, it will adjust the B10 to B11 for this cell, B12, then B13, which is exactly what I want. But it's going to keep the denominator for each of these as B14, which is exactly what I want. And this is a percentage, so I'm going to format it as that. And I don't need any decimal places. Drag that down. And you can see 34% is in the larger U.S. companies and 66% is in the other three. Small caps are these two. It looks like 44% of her money is in small caps, which is pretty risky, but that's misleading. And I will show you that toward the end of this video by doing what's called an X-ray of her portfolio. I also tracked the expense ratio for each of the funds. We're in a time that mutual funds are lowering their expense ratios, which is great news. When I first formed this portfolio for her back in about 2013, the expense ratios were quite a bit higher. They were still low, but they were higher than they are right now. These are the rates as of early 2023. This one has dropped by about half. So that's great. But what this means is for every $100 she has in her portfolio, she's going to be charged 14 cents in management fees. All four of these funds only invest in stocks, in companies of various sizes and in various countries. All four of these are index funds, so they hold quite a few companies in their portfolio. The VTSMX one, the US larger company one, has about 4,000 companies in its portfolio. So does the, I think this is the small cap non-US. Yeah, it has a little over 4,000. This one is the small cap US, only has about 1,500. And then this is the larger size foreign stocks. Collectively, with these four investments, my daughter is investing in about 13,000 different companies, the equity or stock in about 13,000 different companies. So she has a nicely diversified portfolio across different size companies and across different regions of the world. If, let's say, 200 of these 13,000-ish companies went bankrupt, the impact wouldn't be that large because she's still got 13,000 of the 13,277 that are still operating. They're not going bankrupt. But if you had a less diversified portfolio that only had, let's say, 100 companies in it, and 5 of those went bankrupt, it'd probably you'd feel the impact more so than you would if a couple of hundred of these went bankrupt. I also tracked the return that each of these funds generated over the past decade. She inherited the money in 2013, and she still got her money invested in it. These are the returns she has generated on each of the 4 funds. I also highlighted the top 2 performing funds of a particular year. So for 2013, the U.S. funds did better. So the top 2 are U.S., the bottom 2 are foreign. That was also the case in 2014, 16, 18, 19, 20, 20, and 21. The U.S. funds happened to be the top 2 performers for most of the 10-year period, but not for each of the 10 years. So you can see in 2017, the foreign funds did better. And in 2022, one of the foreign funds did better. 2022 was a poor year across the board, but the larger company fund that's foreign had the least poor performance. There's no real reason for me to necessarily highlight which funds did the best. I just wanted to lead to this concept. If she never makes any changes to the weighting scheme of her portfolio, at the end of 2022, it's not going to have the same weights as it did at the beginning of 2013. And this was the weighting scheme at the beginning of 2013 because I decided, based on Vanguard's minimum requirement of $3,000 in each fund that you buy into for the very first time, and based on how young she was and how I wanted to allocate the money based on the risk I thought she could handle for her retirement portfolio, I decided these, which generated these weights. Now, I want to point out the $3,000 requirement that Vanguard has is only for when you first open your fund. If she wants to add more money to it, she can add $25 a month or however much after the fund has been opened with the $3,000 minimum. So what I want to do now is track the amount in each of the funds and the total value of the entire fund over the 10 years that she has owned this portfolio. So what I'm going to do, she started out with $47.60 in VTSMX. And what I'm going to do is multiply it by 1 plus the return that VTSMX earned during 2013. So it earned about 33%, which is not bad at all. So at the beginning of 2013, we put $47.60 in it. By the end of 2013, that was worth $63.07. Now I can just copy this down. My formula will adjust automatically. Since all 4 of the funds generated a positive return, all 4 of the funds have a higher value at the end of 2013 than they did at the beginning. I'm going to copy this formula, which just sums these 4. So I'm going to copy that and I'm going to paste it right here so I can sum these 4. Her $14,000 grew to about $18,000, so it increased by about $3,700 in 2013. 2014 was a decent year for larger U.S. companies, not quite as decent year for smaller U.S. companies, and not so great for foreign companies. What we're going to see when I track the balance for her 4 funds in 2014, I'm going to see these 2 values rise because they're the U.S. ones, and I'm going to see these 2 values fall because they're the foreign ones, and the foreign ones lost money. So to find out the balance at the end of 2014, I no longer start with these values right here. Instead, I work with these values because that's what the funds are worth now at the end of 2013. I'm going to start with this value for VTSMX, and I'm going to multiply it by 1 plus the return for VTSMX in 2014. So our $63.47 grew not quite by $1,000 to $71.36. I should be able to just drag this down, and we can see that the 2 foreign funds, their balance at the end of 2014 was less than it was at the beginning of 2014 because they generated losses. And then I'm once again going to sum those 4 values. And I can see that even though the 2 foreign companies or funds lost money, the total balance rose because the 2 U.S. funds did pretty well. Now I should just be able to highlight these and copy them across to the end of 2022. Originally, she had $14,000 invested. By the end of 2022, that's grown to nearly $32,000. And what I'd like to do is just calculate her overall rate of return. So I don't want to separate it by fund. I don't want to separate it by year. I just want to look at the fact that she started with $14,000. she ended up with 31,880. I'm going to use the rate function in Excel to do that. And I know that was a 10-year time frame. There are no payments. The present value has to be negative, and it's the 14,000 that she started with. And then the ending value or future value in this case is the 31,880 that she ended with. So her annual rate of return is about 8.6%, which isn't too bad. And remember, we had 2022 was just a really horrible year. Just out of curiosity, I'm going to calculate it ignoring 2022. So that would have been 9 years, no payment. The present value would have been that negative 14,000. And then the future value would be this 39,272. So you can see that her rate of return on an annual basis for the decade ignoring 2022 was quite a bit higher. 2022 is just not a good year. The next thing that I'd like to do is calculate the weights of these 4 funds as a portion of the total amount now. I did that back at the beginning. This was the amount that I put in each of the 4 funds, and this is the weight that equates to. Just for the record, I'm going to sum these 4 weights, and they should total 100%, which they do. So this is 100% of her retirement portfolio. 22% is in this one, 22 in this one, 34 in that one. These are the weights that I chose because I chose to put this amount in each of the 4 funds. And let's say I think this weight is a suitable weight for a young person. And now she's 23, and I still think that this allocation is great. And now as she gets older, although this won't happen for a while, as she gets older, I would add some bonds to this portfolio. I would decrease the weight of small caps and things like that. But for now, given how old she is, I think this is a perfectly fine weight. I want it to be these 2 are my foreign funds. So it was about 44% foreign, 56% US, and then about 44% small cap. But now, after 10 years have passed, and these funds all earned different returns, and the reason I highlighted those returns in green, I can see the top 2 rows are the US funds. I can see that the US funds did better a lot of the time. And that means the US funds are going to have a higher weight now than they did when this portfolio was established 10 years ago. So what I'm going to do is take the amount in this fund and divide it by the total amount in her portfolio, make it an absolute reference, the divisor. That means when I copy this formula down to these cells, it will use this number as the numerator, but still use this number as the divisor. And that's what I want. This sums the value in the 4 cells above it. So if I copy this formula across, it will also sum the values in the 4 cells above it. It's currently these 4 values sum to 100% or all of the portfolio. And originally we had 34% in VTSMX and 22% in the other 3. But now you can see that VTSMX is almost half of the whole portfolio. The small cap US is a little above 20%, but the 2 foreign ones are far below 22%. And I wanted them to be at 22%. This alludes to something we're going to do in Chapter 17, which is rebalance our portfolio. A portfolio needs to be rebalanced periodically, definitely more than once every 10 years. And I will show you how to do that process and how often you should do that process in Chapter 17. Now I want to show you something called a Morningstar X-ray, instant X-ray. Here is the URL. You do need to create an account to access this, but it's free. They have a premium Morningstar, and also they just give you access to a certain level of Morningstar for free, and you do get this for free. It doesn't go in depth though. The really in-depth stuff is at a premium. I entered my 4 tickers, and I entered here the amount that I put in the fund at the beginning of the decade, so in 2013, based on my numbers. I'm going to have it show the instant X-ray. This gives me a composite of all 4 portfolios combined. When I go into Morningstar and I type in a single ticker for, let's say, VTSMX, the output that it shows me is for just VTSMX. But this particular instant X-ray shows me the combined features of all 4 of those funds given the weight in each of those four funds. So I can see that most of the money is invested in US stocks, 55% of it. A good portion is in foreign stocks, and that's what I wanted. It might be okay if I made it a little closer to 50-50, but I was content with this whenever I first bought those four funds for my daughter. This interest rate sensitivity is only related to bonds. Since there are no bonds in this portfolio, it doesn't have any values for this matrix, but it does have values for my valuation matrix. 17% of the 14,000 that was put in the portfolio were large cap growth stocks, 11% large cap value stocks, 8% small cap value stocks, etc. I can see that I've got a pretty good balance between value and growth, which is what I wanted. I can also see I've got not an equal balance between large, mid, and small cap stocks. I didn't want as many small cap stocks as larger companies, because small cap stocks are riskier. So if I sum these, I get 25% is in small cap stocks. I think that's a good amount. If you're more of a risk taker than I am for my daughter's sake, then you might want to have more than 25% in small caps. I know somebody who's in his 70s and he has 50% of his portfolio in small cap stocks. But for my daughter's portfolio, I think this is nicely balanced. Let's look at the regions. So I can see that 61% are in North America. So that means since, 55% was US, I've got some Mexican and Canadian stocks in there. About 12% is in developed Europe. I do have some in emerging markets. So I've got 6.43 in Asia, 1.34 in Africa and the Middle East, 0.32% in emerging Europe, and 1.07% I would consider some of those emerging markets. I've got a decent percent in emerging markets. I personally like to keep this emerging market percentage to around 5%. It's a bit higher than that, but this is my daughter's portfolio, so I'm willing to take a little more risk for her. It also breaks down how much it thinks I would pay in annual mutual fund expenses for the $14,000. Because all of those funds had low fees, it calculated the average expense ratio, 0.14%, and based on that $14,000, it thinks I would pay about a $20 annual fee altogether. And to me, that's not bad at all. If it were $20 on a $1,000 investment, I would think differently, but this is $20 on a $14,000 investment. And in a bit, I'm going to redo these weights based on the values as of the end of 2022. And things will change a bit. But right now I'm just showing you how I wanted the portfolio to be set up and how I did set it up in 2013. If you look at the sectors, you can see that none of the sectors have a weight of 0. They're not evenly balanced, but neither are the sectors in the entire world. Overall, like the technology sector has a pretty high weight across the world. The weight in technology companies is only about 16% for her portfolio, but if you look at the comparison, it's 23%. This 23% is just for large cap US stocks. So my goal was not to get these weights here across the different sectors to equal the S&P 500 weights. But I can see, I'm off, but I do still have weights in every category. And generally speaking, this is the highest weight for the S&P 500. This is also the highest weight for my daughter's portfolio. This has a very low weight utilities for the S&P 500. It also has a low weight for my daughter's portfolio. It's nicely diversified across countries. It's nicely diversified across sectors. It's nicely diversified across size of companies and value versus growth. So now I'm going to go back to Edit Holdings, and I'm going to change these values to reflect what the dollar amounts were for 2022. So essentially I'm going to come over here and input these values. Now I have those values inputted, and I'm going to re-examine my instant X-ray. So you can see this before this was 55% in US stocks. I can't recall exactly what it was in foreign stocks. I think it was 44 or something like that. But you can see the weight of US stocks in my portfolio is much higher than I wanted it to be, assuming 55% was where I wanted it to be, which is a safe assumption. My portfolio is heavily weighted toward US stocks now. and it needs to be rebalanced. Again, I really probably should have saved that instant x-ray from the original weights so that I could easily compare them. I can still see that it's decently balanced between value and growth and small cap versus large cap. But let's check out the emerging markets. So 4.22, 0.88, 0.21. I recall that these numbers were all higher, the emerging market numbers, before. So now not only has the weight of my foreign stocks dropped, but the weight of my emerging market stocks has dropped as well. So if I do want to maintain the same type of risk that I had at the beginning of 2013, again, this portfolio needs to be rebalanced. What that means is that I'm going to have to come over here and sell some shares in these two US funds, use the cash that generates to buy more shares of these two foreign funds. I'm not going to go through that process today. That's the subject of chapter 17, so I'm going to wait on that, but that's the idea behind rebalancing.